All right, now investment strategist Ed Yardeni coined the term bond vigilantes back in the 1980s to describe bond investors demanding higher yields to pressure governments to spend less. But with the 10-year Treasury still right around 2.5%, where are the bond vigilantes today? Let's ask Ed Yardeni himself the question that probably people ask you every day, Ed. I hope you're not sick of answering it. Everybody still wants to know, is it just sort of the looming possibility of $1 trillion in quantitative easing that holds the bond vigilantes back?
Yeah, absolutely. I mean, the bond vigilantes are private investors in the bond market, and in the past, they've always been concerned about excessive government deficits and too much money creation. But when you got the Federal Reserve keeping the federal funds rate at zero, it's hard to drive the bond yield up.
What do you make, though, of PIMCO, though, beginning to sell treasuries because they're doubting the effectiveness of QE2?
Right. Well, I guess they're the ultimate bond vigilante, right? I mean, they really do count for a tremendous amount of influence in the marketplace. But look, when you look at where the bond yield is, 2.4%, it's conceivable that would get down to 2% on QE2 if it's announced on November 3rd.
Really?
When the FOMC, yeah, I mean, it's still a possibility. Look, if the Fed actually comes in and announces they're going to buy $500 billion of securities over the next 12 months, it's basically a sizable chunk of the deficit. It's going to bring yields down.
Does it stay down then for very long? Let's say that scenario plays out.
Yeah, I don't think it does, because I think the economy is actually doing reasonably well, and I think QE2 is really not necessary. QE1 was necessary to stop a financial meltdown. QE2 is designed to bring the unemployment rate down faster, but I don't think it's going to work, and I think what's going to happen is a lot of the stimulus is going to go overseas and bring stock markets, commodity markets higher.
I wonder about the return of the bond vigilantes. I mean, what will it do to the U.S. economy? Obviously, with such huge deficits, we're looking at interest expenses of, I think, almost $400 billion last year, more than $400 billion this year, just to pay the interest on U.S. debt. What happens if it bumps up 2 or 3%?
This is where the risk is in QE2, is the Fed right now overreacts, is too concerned about the weak economy, comes in, and suddenly the economy looks pretty good, let's say in March of next year, and suddenly they have to reverse themselves and say we have to start thinking about exit strategies again. The bond yield could go from 2% to 3% in a heartbeat, and that would be a very dangerous situation for the economy.
How dangerous? How would it play out in your view if we got such a dramatic shift so quickly?
Well, there's a lot of talk that we are in a bond bubble situation, because we've seen a lot of individual investors who would probably much prefer to put their money away safely in a CD or money market instrument. They just can't do it because the rate is so extraordinarily low. So they've been forced into the bond market just in time to get some substantial capital losses if, in fact, the economy starts to pick up and the Fed has to reverse course again. Remember, it was March of this year the Fed was already talking about exit strategies. Now they're talking about getting back in and doing even more Treasury purchases.
Some of the biggest minds, though, in economics, I mean, Paul Krugman, Joe Stiglitz, are all saying, don't worry about inflation. Who cares about it now? The Fed can easily control inflation here. Is that the case, or is it the kind of scenario that can get out of hand?
I really don't think inflation is going to be much of a problem in the United States. It's certainly not a problem in Japan or Europe. It's a big problem in the emerging economies, and that's where the growth is. And we don't want to force them to step on their brakes, because that's the only growth that really we are enjoying in the global economy.
Well, is it problematic then what we saw the Chinese do this week in terms of slowing down some of the lending that's going on with banks, or is that a good thing? We want to see that happen.
This is what's going on with QE2. The anticipation of QE2 is driving the dollar down, and that's causing a lot of tensions in the currency markets. And the Chinese at the IMF meeting said, look, you can't keep doing this because you're creating a lot of problems for the emerging economies. You're driving commodity prices up. You're driving our stock markets up. You're creating too much liquidity for us.
Because at this point, it's not a liquidity problem anymore, right? It's just about demand.
The capital markets are wide open. The corporations that have access to capital markets can get money. Now, small companies obviously have a problem, but they're not saying it's their number one problem. Small companies are saying their number one problem is they want customers. They want business. Right. And a lot of that has to do with all of this intervention by the government on the fiscal side and the monetary side.
Let me just ask you quickly about the idea of bond vigilantes. Are these people, are these really investors, or are you talking about market forces here?
Well, I mean, we saw the bond vigilantes. I was on here during the summer. Remember, we had the bond vigilantes show up in places like Greece and Spain and Ireland. So you have to look at bond vigilantes as kind of a global phenomenon. And, some people have started talking about currency vigilantes. This is really markets trying to maintain some law and order for the economy. But if you've got fiscal authorities and monetary authorities out of control, it's pretty hard for the bond vigilantes to do that.
5 seconds, do you think they are out of control at this point?
Yes.
No doubt about it.
You give me 5 seconds.
Next time, we'll give you more.
Ed, thanks so much for joining us. Ed Yardeni, president of Yardeni Research.